Other than the prohibited transaction rules, the unrelated business taxable income rules as it applies to solo 401ks are probably the next most important set of rules for one to understand if one wants to use the solo 401k for alternative assets. So the unrelated business taxable income rules are rules that many people aren't aware of. Many people don't even know they apply to 401ks or IRAs. Basically, unrelated business taxable income, it's a body of rules that can be found in the tax code from 512 to 514 in the Internal Revenue Code. Basically, if you look at its history, it was initially meant to apply to charities. So the whole point of these rules were basically Congress was worried that companies like McDonald's were going to set up charities and then run their business through the charity and never pay tax. So they said, whoa, that's dangerous because if that's done frequently, we'll lose our tax base. They set these rules up and said, if a company does three things, or a charity does three things, these three things will trigger a tax. I'm going to treat these activities like a business, okay? And the three items are such. Use marginal by stock, which isn't really relevant for my clients, because generally most margin accounts you need to personally guarantee it, and that's a no-go because it will violate the prohibited transaction rules. So number two, use non-recourse loan to buy real estate. The IRS and Congress felt that was more akin to a business. It's more aggressive than just a passive investment. But we know from 514C9 there's an exemption for 401ks, not for IRA. So one of the main advantages of a solo K is if you're a real estate guy and you use a non-recourse loan to buy real estate, you can get around the unrelated business taxable income rules and get around paying the 37% tax by taking advantage of the 514C9 exemption and using the 401k to buy real estate as long as the loan is non-recourse, a loan you're not personally guaranteeing. If you use a recourse loan, you're in bigger trouble because you just blew the prohibited transaction rules. But if you can get a non-recourse loan and use it for real estate acquisition, then you can circumvent the UBTI rules, get around the 37% tax, and really supercharge your solo 401k real estate investment portfolio by using leverage. And then the third category of items or categories of transactions that can trigger the UBTI tax is if you invest in an active trader business, like a store that's operated through a pass-through entity like an LLC. So a pass-through entity, think about it as like a funnel or an LLC or a partnership where the entity does not pay tax, but its owners do. So unlike a C Corp, which is like a big box, which has a corporate level tax, which is now 21%, once the corporation pays tax, any retained earnings will get dividend up to the shareholders. In the LLC or partnership world, the entity does not pay tax, the owners do. So these rules, the way they get applied is that if your IRA or 401k invests in a pass-through business like a fund or a store or a restaurant or a consulting business, manufacturing business, and it's operated through a pass-through entity like an LLC or partnership, it would trigger the UBTI tax at 37%. So that's the third way the UBTI tax gets applied. There's no exemption, unfortunately, for 401ks. IRAs and 401ks and charities get hit equally on this. So if you're an IRA or 401k and invest in an active trader business, a restaurant or consulting business, make sure obviously there's not a prohibited transaction issue. Make sure you or a disqualified person are not in that business. If that works, then make sure that if it is a pass-through entity, you understand these UBTI tax rules. It's a 37% tax. I can't tell you how many deals have died because of this tax where people say, oh my goodness, I don't want to pay 37%. I'm walking away. I'm not doing the deal. I'll do it with personal money. And that's fine. I'd rather my clients do it now versus after the fact where they just kind of wasted time and capital. The one potential way around this 37% UBTI tax for obviously the non-recourse loan in real estate, it's not an issue with 401ks because there's an exemption under 514C9. But if your solo K is going to invest in an active business like a store through a pass-through entity, you can set up a blocker, a C Corp. And remember I mentioned the C Corp tax rate is now 21% thanks to President Trump. It used to be 35%. Now it's 21%. So some people say, you know what? I can live with 21%. It's like a capital gains tax. It's much less than 37%. I'll set up the blocker. It will block the UBTI from going to the 401k, I'll pay my 21% tax, dividend everything back to the 401k after that, and I'll live with that. That's fine. But it's important that everyone understands the rules. You want to understand how to navigate the UBTI rules. Again, 3 ways to trigger UBTI on 401k. Margin to buy stock, not really relevant. Non-recourse loan for real estate, not really relevant on 401k because of the exemption. And investment in a pass-through business like a store through a pass-through entity like an LLC or partnership. The only way you minimize that UBTI 37% tax is through the blocker, which will impose a 21% tax. So just be careful. If you have UBTI tax implications, be thoughtful of it, talk to a tax professional, make sure the deal works for you, make sure you kind of have seen all sides of it. If it kills the deal, fine, that's fine, but just make sure you understand the tax ramifications. Better to kill a deal now than waste all this time, do the investment, and it turns out it's not tax efficient. So, you know, the UBTI really traps the unaware. This is when you don't work with the right people. Can't tell you how many people I get that call me and say, oh, I set up an IRA 3 years ago. I just read your article on Forbes or read your book. I never heard of this UBTI. What do I do? Well, you haven't filed tax returns for 3 years. I don't know. Go find someone that can help you. How do you report UBTI? Pretty simple. It's called a 990T as in Thomas. You file it. You can get an accountant to help you. If you have over $1,000 of UBTI, you'll pay it. The good thing is if you do get hit with UBTI, the IRS will let you take into account deductions, depreciation, things that will allow you to reduce that UBTI tax implications. The idea is like, hey, if you're going to tax you on it, we'll at least treat you like a taxpayer and we'll let you take into account other deductions. So it could be minimized, but either whether you're using the C-Corp blocker or you're just using other deductions to minimize the tax, it's there. And the solo K gives you the exemption under C9, 514 C9 for real estate. But if you're investing in a pass-through entity, other than the blocker, you're either stuck paying the tax or you may want to walk away from the deal. But again, just remember the UBTI rules. They're important, just like the prohibited transaction rules. They won't blow up your deal, but they can create a very tax inefficient structure for yourself. So again, beware of UBTI and think about it before doing a deal.